always going to be difficult for the Fed to be able to cut when the government was spending so freely, running substantial deficits at a time when we're not in economic recession. And so I think we're going to sit with this policy mix of higher rates and higher government spending for some time.
How about zero rate cuts this year? And I'll tell you, Kevin O'Leary has that view. He thinks rate cuts this year are a fantasy that the market is playing with. We've had Matt Higgins yesterday talk about how there's a probability, a decent probability of that happening. However, David Roche doesn't think so. So I'll bring him into the conversation, but I do want to get your sense in. Do you think that there could be a chance of no rate cuts this year?
There is a possibility of no rate cuts, but I think Powell does. I think he doesn't want the Fed to be overtly political ahead of the November presidential election, and so I think they're trying to chart that path of managing to the data. The fact is, the data hasn't been all that helpful to them being able to cut.
David, come in with your thoughts and a question for Euan.
Yeah, well, I would say the question is the likelihood of no rate cuts, I think, is pretty low, unless we really get some awful performance of the data, particularly around something like the core inflation rate. And that looks fairly unlikely. It might be sticky, but it's not going to be bad enough to stop any rate cuts. The second thing is, I think Powell is psychologically prone to cut rather than not cut. I thought that was pretty clear from his remarks yesterday. He wants to cut. I don't think one can say with certainty that there's going to be 3 rate cuts. You could tell me there's going to be 2, and I don't think I'd be terribly shocked. That would be quite easy. But that the rates will come down, yes. But I want to come back to one thing you said, which I think is very important, that if you have large budget deficits, which the US has, and it's going to go on, and debt is going to go right through 100% of GDP and carry on climbing into the skies. If you have that, then essentially that influences the equilibrium level of interest rates, the so-called terrible cold R asterisk, R star. And if that happens, then although we get our 2 cuts or 3 cuts this year, the actual total number of cuts and the level of interest rates at the base of the cycle will be actually much higher, maybe 100 basis points higher than previous cycles. And the market cannot ignore that, and the Fed cannot ignore it either, even though it's not taking it into account at the moment. It'll have to take it into account. So what I'm saying to you is, asking you politely and humbly, is where do you think the bottom of the cycle is? Because I think it's much higher because of what you said about budget deficits, and there are other factors, which raises the equilibrium level of interest rates. That's how my little mind works. I wonder how your big mind works.
Well, I think we actually agree. I've been arguing for higher for longer. I remember when we moved into the recovery from the global financial crisis, and obviously short-term interest rates came down, and interest rate futures predicted for a very, very long time that interest rates were going to go back to some sort of level that had been the pre-banking crisis norm. So, and eventually, by about 2021, that sort of expectation was squeezed out, and we're going to have low interest rates forever. I think the market has still got to wake up to the fact that we're in a very difficult regime than we were in pre-COVID, pre the war in Ukraine. And so I think the market's straining to get back to some sort of expectation that we're going to be back to some equilibrium rate that applied before COVID and before the rise of the war in Ukraine, and I suppose increasing geopolitical tensions in the world, and the role that big government plays, because I think COVID and increasing spending on defence, all of that is making governments have a bigger role and spend more. And I agree with you, David. I think that means that interest rates will be permanently higher, and I think the market's over-optimistic.